out of it. A big driver of what happened was caused by the Federal Reserve manipulation of interest rates. As someone who believes the Federal Reserve shouldn't even exist, it's hard to defend what they did. But they kept interest rates low and they created bubbles. Every time there should have been a recession, to kind of clean things up and erase malinvestment, the pinheads would lower interest rates, and I mean the pinhead Alan Greenspan, for 18 years that he was in there, would go in and lower interest rates, and that would just cause the bubble to not deflate. It would clean things up, make things look good, and build a new bubble. We went from the dot-com, telecom bubble to the real estate bubble, and all our affirmative action president's doing now is trying to create a new bubble. All that money has to go somewhere. And this time, the only place it seems left for it to go is going to be hyperinflation. Because they're creating so much money out of thin air. And I don't think the Chinese want that much more of our money. Even the communists have figured out we're going to cause inflation.
So you think that companies like AIG took on all of this risk without adequate underwriting risk and still be left unregulated? And we should learn a lesson from this and let the cards fall where they may. The government and regulating it, maybe they regulated AIG to the point of limiting the amount of contracts they would insure. What's your answer to that?
Well, I agree. I think that there are people out there who took risks. They should have been hit with the losses. It's just, there's no difference between the banks and the car companies. People say we need car companies. We have them. They're called, we have American car companies, Toyota, Honda, BMW. They make cars in the United States. A Toyota Camry has more American content than a Chevrolet Malibu. Yeah. The banks, if Citicorp fails, so what? Somebody else will take them. There's lots of money out there. Because all of these transactions, all these derivative transactions, there is no net loss. All that money went somewhere. Somebody made money, somebody made commissions, and other people lost money. These are all zero-sum games. There's no loss in the derivatives. There's loss in the mortgage market, and that people lent money that'll never get paid back. But the derivatives were all zero-sum events. So somebody made a lot of money, the smart guys made money, the dumb guys lost money. I mean, AIG is a very special case. Because before AIG got into financial products, they were almost Berkshire Hathaway quality credit. They were AA rated credit. They had this massive international property casualty life insurance, airplane leasing company. So a guy came in to Hank Greenberg, who was the CEO for 37 years, and said, we can use your credit rating to write these financial products. Well, Hank Greenberg got pushed out in 2005, and that let the financial products guys go crazy. And you can blame that on Elliot Spitzer. Elliot Spitzer got Hank Greenberg out of there because he was protecting AIG shareholders. Well, when he got Hank Greenberg out of there, the stock sold for $90 a share, and now it sells for $1.80. So he really protected those shareholders. Is a menace to society. I mean, it's, Audrey. Municipal bonds first off, we've learned. Okay, Audrey's asking about the municipal bonds issued by the state, cities, and counties and other government organizations and the companies that insure them. There's the government, the United States government, has created an oligopoly of rating agencies. Unless you're on the United States Treasury list as a qualified rating agency, you don't count. So you have a government-granted triopoly. There's three companies, Standard & Poor's, Moody's, and Fitch. And they can charge outrageous amounts of money to rate things. You have insurance companies called the Municipal Bond Insurance Company, Financial Guarantee Insurance Corporation. And there's only a handful of them. There's a new one out there formed by Warren Buffett that have historically made money by insuring municipal bonds. The rating agencies would rate the state of California as a double B risk or something, and then they would charge 0.5% on the bonds to get them to be AAA rated, and then sell them because it was the difference in the interest rate in the market was less than what these bond insurers charge. What we've seen is that bond insurers, because they took on other kinds of risks, don't have the money to make good on the bonds if they default. But it also is obvious that the rating agencies, in their ratings, discriminated against municipal bonds. They gave them lower ratings than they deserved. Because, let's face it, it's the number one, under the Constitution in California, bondholders get paid before anybody else. And they still have a tremendous amount of taxable tax money coming in. So the fact is those bonds are not bad. They were rated lower than they deserve, and between the rating agencies and the municipal bond guarantee companies, they had a nice little racket going. And they had that racket going because they were government sanctioned. The rating agencies and the bond insurers. So.
One category you talk about is medical insurance. Is there a black hole forming as they move to nationalize the healthcare system? How are the insurance companies lining up to become the cronies, or how's that involved?
Well, I think I referred to them as health insurance companies, but your medical insurance is such a short term. I mean, you pay a premium this month, they pay claims this month. There's so little delay between the time they collect premiums and pay claims that there's no investment risk there. Now, as the government nationalizes medical insurance, obviously there's going to be holes. There's a $60 trillion hole in Medicare. They've promised benefits in excess of premiums of $60 trillion. Obviously they're not going to be able to make good on those benefits. The combined in the 2009 trustees reports for Social Security and Medicare came out in the last week or two. In fact, they came out Tuesday, I think. And the combined deficit of Social Security, the Old Age Survivors Program, the Disability Income Program, Medicare Part A, B, and D is now over $100 trillion. If the actuarial reports accounting for this, the moderate assumptions are now over $100 trillion. 12. Actually, it's 14. It's 100 trillion. One with 14 zeros. It's like, what, 7 or 8 times the gross domestic product of the United States. I mean, it's just this phenomenal number. You know, and if you want to go further, you take all the state governments